Hi, this is Ashish Shaker, and I'm happy to present to you the snippets of our October version of the Alpha Strategist. It's titled A Long Winter, and the reason for that is that we've been waiting for earnings pickup for the broader markets in India for quite some time now. Just when we thought earnings would pick up, we had the demonetization announcement, and then you had the GST rollout. Further, we've been plagued by huge NPAs in the banking system. Last year, we also saw the collapse of one of our largest financial institutions, which is in the non-banking finance space, and NPAs have been piling up in that space as well. As a consequence, what has happened is that liquidity is running extremely tight. Post budget, the sentiments further soured due to the introduction of super HNI tax as well as surcharge on capital gains. However, what we've seen is in the last month and a half, the government has acknowledged that there is a slowdown in the economy, there is a demand problem, and they've rolled out many measures to counter this slowdown, starting from removal of the surcharge on capital gains, liquidity window for NBFCs, lowering GST for the real estate sector, and finally they announced big tax reforms for corporates, wherein they cut down the corporate tax rate to 25%, and they have announced a new tax rate of 15% for manufacturing companies who set up base in India starting October 1st, but start producing before October 2023. We believe that the government is now on an overdrive, and there are several changes that are being planned on the personal income tax as well, which we'll probably likely see around the budget, which is going to happen first week of February. In equity markets, there are a couple of things that make money for investors over a period of time. Either you have growth on your side, which is during high growth phases, even if markets are expensive, you end up making decent amount of money. Or you need to have valuations on your side, that the stocks are so reasonable that any positive uptick causes stocks to run up and you make money. We believe we are in the latter situation. There is a lot of pessimism around, there is a lot of negative commentary about growth. However, the silver lining is that the government is doing a lot to revive growth. At the same time, if you look at the central bank, RBI has cut rates again to 5.15%. The repo rate is the lowest it's been for quite some time, and we don't think they're done yet. We could see another 25 basis points because inflation is still running in the band of 3 to 4%. Coupled with the negativity that we see in terms of commentary and the overall pessimism, and on the other side, the fact that government as well as the central bank has gone into overdrive to spur demand and to bring back growth, we believe this is a nice cocktail to further your equity investments. In fact, for the last few months, we've been saying that one could stagger their equity investments as they build up the allocation. We strongly believe that after the recent spate of measures that the government has announced, this is a good time for people who want to invest in equities to do so right away. I know the fear actually is that most investors fear if they put in 100, we think the journey to 200 will happen over the next 4 to 5 years. However, most people are very worried about whether this 100 will become 80, and that's always a constant struggle psychologically to put in money when things are negative. Often we do feel markets are expensive, and we say we will wait it out. We'll put in money once things are great. But remember, when things are great, prices are not. And when the economic situation not that great, you get prices which are reasonable. So we believe it's a very, very conducive time to finish building portfolios. According to us, the most attractive spot is multi-cap strategies or multi-cap funds, because these are funds which have the flexibility to move between large and mid and small caps pretty swiftly. Certain niche mid and small cap strategies also could be considered. However, one needs to understand that the wait for performance could be a bit longer, because mid and small cap strategies typically are a function of liquidity, and as the economic situation improves, these smaller and medium-sized companies could improve their P&Ls much faster than their large cap counterparts. So we do believe it's a great time to relook at equity allocations and maybe finish whatever is pending. On the fixed income side, we continue to be risk averse. We continue to believe that given the economic slowdowns, it's a season for downgrades, and many companies are facing balance sheet issues. Although spreads are very attractive, the AA single A space is quite well priced. We would continue to stick to high quality funds in the PSU banking space. You could also look at keeping some money in liquid and arbitrage, because you could get an opportunity to lock in money in credit funds at higher spreads in the very near future. On alternatives, we are continue to be positive on gold, because we believe that the way global markets are moving, we are seeing slowdowns in major parts of the globe, including China, Europe. US continues to do well. However, there is a lot of sovereign debt globally. As you know, most countries have been in an expansion mode again, where they've gone from tightening to a new phase of quantitative easing. Now, normally these kind of circumstances are conducive for gold investors. We don't know who will blink, what will cause people to probably lose faith in currencies or certain countries. However, gold is a very good hedge against any global crisis. So gold is a good asset to have currently in the portfolio. However, as always, I think it's prudent to look at your investment charter, your investment framework, how you're allocated across different asset classes. The best part as investors is that we don't have to second guess which is going to be the best asset class over the next 3 to 5 years. We can own 2 to 3 asset classes at the same time, so that we get an experience which is more balanced than single asset class owners. Thank you very much.